All right, so we got the double swap going on here. I was in New York. Now I'm here in LA. Mike's absent. So, Stefan, you get to be our very first guest.
I love it. I love to be the first guest. Want to set the threshold really low, so low that other people will trip on it in the future.
And, one of the things that we always do is we usually introduce ourselves. So I was like, I'm Drew Carrick, the rapping CPA. You usually have Mike Whitmire, the inactive CPA. What could be your CPA nickname be?
That's a good question. It's really hard to nickname yourself. Anytime I feel like I venture down that realm, I just get ridiculed by my friends. So I guess I'll just stick with accounting operations evangelist, even though it's a funky title, but it works. It works.
Yeah, it works. And absolutely. So with that being said, welcome to the show. I'm excited to co-host it with you, and let's get flowing.
Let's do it.
FinTech Flo.
All right, so obviously you might be familiar with the format of how we do this. We've got our up-to-date section where a lot of stuff going on in the accounting industry, finance, the economy, technology, all these different areas. We got a few different areas that we pulled articles from. So one of the things that I saw right off the bat, which was pretty interesting, this is from the Wall Street Journal, and it was just the benefit of owning stocks over bonds keeps shrinking. Right, that's the title that we got going on here. And I don't know about you, but like, what's your investment strategy sort of been as you approach this market currently? Like the accountant to me is all about like diversifying. I've thrown money into every single area. I've started to think about like, do I need to get gold blocks? Is that the move that I have to make? But what's your sort of approach and strategy been during this kind of turbulent time?
Well, just, if you ever get to the point where you're holding cash in your bed, just let me know where you live, and I'll use that as my investment strategy. No, I do think diversifying is solid. I don't think people should overcomplicate the process. By no means am I a financial planner or, I'm an armchair investor at best. So please don't take any of this too seriously. But I don't like to do too many day trades. I'm not too much of an armchair investor. I like to keep it simple, and I like to hold it long, right? So when you look at like the advice you get from some of the most wealthy people and some of these different stockholders, like, the stock market is a long game. Valuation is a long game. And so why I diversify, I kind of like put so much in S&P tracers, and I put so much in Russells, and then I have so much in bonds, and I just kind of keep that ratio, and I don't really mess with it because over time it really should right the ship. But I think it's to be expected. I mean, I think when you have tightening of monetary policy, if you have interest rates rising up, you're eventually going to see something like this happen. But I'm not the type to go in and immediately just knee-jerk be like, well, I want to change where I'm trading, and that's mainly because I don't day trade too much. Sure. I take that back. I day trade a little bit on like what I call like sin indexes. So, but that's like a whole, I would say those are like fad indexes. I like to day trade on like, are people going to buy more alcohol this month? And I'm investing in that. Or are they going to be, how are cigarettes doing? And that's just because I find it comical to me. But I don't really get too heavy in the other things. But I think what, the tough thing with bonds for me is like, I just never felt like they've really pulled out long-term in any of my investment strategies. So why I've diversified into them, I'm like, this doesn't really do a lot for me. So
that's the interesting thing about what this is kind of like portraying is we're in this weird time right now where like, I don't know about you, but like I logged in this morning to look at my stock portfolio that I have I just have a little bit of like fun money. It's not your long-term 401k plan. It's just you're like, if there's something trendy, I want to get in on it. My friends are all investing in something like, let me get in on it and see what that's about. And then I went into my Marcus, my Goldman Sachs savings account, and I got my email this morning that was like, hey, you're going to get now 4.4% on your CD. And I'm like, well, geez, like I could make, I could, if I just leave the money in the CDs or in even the online savings account, they have no overhead. So I'm getting a 4% return. And I don't, and that's what this is kind of talking about. It's like, you don't know if you're necessarily getting that from the stock market right now. Like I've just watched my money go down, by 20% over the course of the time I've had it in my investment account. versus the CD or the online savings account, which just keeps on kind of growing. And I think it obviously has to do with the interest rates, which is just, it's the safer stuff is now more valuable than it was to be as risky, as they say, with the stocks. And I wonder if this, how this will then impact things moving forward, because if it's not worth investing in the stock market because it's just the returns don't warrant the risk, and you can get it's not the best, 4% is not the best thing ever, but it's at least keeping you up with inflation, right? Yeah. Then maybe that's the incentive there. So I just want to read a little piece from this article, basically highlighting that the extra reward for holding stocks instead of bonds has fallen to its lowest level in 20 years, threatening a recent hot streak for major indexes. One method for gauging the value of stocks is to compare their earnings yield, calculated by dividing a company's expected earnings over the next year by its stock price, to the yield on government bonds, considered the closest thing to a risk-free return. The difference sometimes is called the equity risk premium and shows how much investors are being compensated for the additional risk of owning stocks. I don't know. I mean, I guess the hope is that risks premiums could normalize because bonds, bond yields fall rather than stock prices, but that really only happens, I think, if the interest rates stop climbing.
Well, and you got to remember, what did we just come out of? We came out of a period of just excessive stock market growth, right? If we look over the last 4 years, it was just going ham, and there was little blips here and there from different economic and social economic conditions going on, but stocks valuations are really getting out of hand, and so I think it makes sense that that value, that yield versus stock price has to right that ship, and it's going to continue to right it, and we've seen that happening over the last 12 months. And bonds are going to hold steady as long as the interest rate's doing what it does. So I think it's a little bit, but if you look at the stock market, there's plenty of, I would say, day trading options where you see, you read back that someone's stock just rose another 18%, 20% because of an earnings call. And they're not, every day, but, JP Morgan with with taking over Silicon Valley Bank's assets and some of these other banks that were collapsing. And so there are winners out there, but I think when you have an overly diversified portfolio in tech, or in the S&P 500 where a lot of these tech companies exist and they're really struggling due to their overvaluations, you're kind of getting in that space where the risk-free is looking a little bit more enticing. But again, I think if you're going to get into stock market, you need to understand the principles of why you're investing in a company, and how that aligns with your, investment strategy and what you want to achieve. And then you need to hold it and give it time, because I think the tragic thing about the stock market is a lot of people expect pretty quick results. But as someone and you've seen this too in your experience, when you're inside of an organization trying to accomplish things, it doesn't happen overnight. There's no spigot to turn on, and all of a sudden just revenue goes through the roof or costs decrease. You put in strategies that take time to really ferment and provide growth. So you kind of, in my mind, I want to, as a controller, in the past, I want to invest in the company and give them a chance to kind of achieve those results. So I tend to stay out of a lot of this stuff. But yeah, I've looked at my Robinhood plenty of times and just been yeah, I'm just going to act like I never did this. I act like it never happened that day. I'm just nope, that's really bad news. And I'm going to ignore it and see what happens in a week. Yeah. That's because it hurts.
Yeah, that's one of those things where I never was one of those people that's going to look at the market one day and be like, oh my gosh, my portfolio's down. I have partners at my accounting firm would be like, I'm down $17,000 today. And I was like, yeah, but you could be back to where you were in a week, and then you could be up 5,000 the day after that. So just get your head out of it and don't let it impact you.
I can think of several times where I was at some kind of, networking event trying to do business development at, KPMG or at CBIZ when I worked there really early in my career. And something happened, politically or economically, and you'd be sitting there on the golf course with, 3 other people in your cart. You could see, you had carts in front of behind you that you were all trying to drum up business, and all of a sudden people just left. You saw everybody pull out their phone, and then you just saw people leave the golf course and just not play the rest of the day because they're I got to figure this out. And at the end of the day, it's well, nothing really occurred. You didn't change anything. You didn't pull your money out of anything, because if you did, you were just settling in the loss. It was better to hold it longer. And it's just kind of interesting to see how that plays out sometimes.
It's not a loss until you sell. So
that's right.
Until you get out. So other things that are happening in the space, a little bit pivot now into the accounting world, is the SEC approved cybersecurity disclosure rules. This is from Accounting Today, where it just said the Securities Exchange Commission approved new rules that will require entities to disclose material cybersecurity incidents. And I think this seems to be the trend of the accounting world in general, where it's starting to like expand in scope a little bit. Of, originally it was just financial statement audits. You're just looking at the numbers. You're just following the money. Then they started to add all the, the COSO framework. You had all the internal controls and all the aspects that come with like, well, how do you make sure that your internal controls are in place? And that kind of feeds right into being compliant, especially when it comes to the public companies. And cybersecurity is like, this is the crime of the 21st century. I mean, it's almost like daunting. This is another area where I feel like I can't even think about how exposed we are at any given moment to identity theft or to credit card fraud. And you just kind of hope that it doesn't hit you. I think this is it's going to be interesting. And obviously, we love disclosures. The more you know, the more informed you can be. So I think it's pretty fascinating that, this is going to be added and throw this into the audit reports, because it's important. I think that people know, like, well, how many times is your company getting slammed with this? Because this is a huge liability.
Well, and I think it just goes to show that investors, the SEC has always had a very limited tolerance for risk. And I think as time has gone on, the SEC has become a little bit more firm with the way they look at risk and what the auditor needs to kind of absorb within that relationship of, assurance. I would say that I think they overdo it personally. I think they're a little bit extreme. And I think if you are going to invest in the markets, you need to be able to take on a certain amount of risk as an investor. It's not risk-free, it's not guaranteed, and you can't assume that it is. But yeah, I do think it's interesting. You've seen so many articles in the news where people are paying, millions of dollars in ransomware, right? Mm-hmm. And people are paying, millions of dollars to try to prevent ransomware. And I think the SEC has seen enough at public companies and had probably enough feedback coming back in investor calls that they're like, we probably need to have actual disclosures around this and have a measured amount of reporting with it. So I think it's, in some ways, I think it's a step in the right direction, but I do think there's this kind of tenuous thread or this tenuous balance between what auditors can audit within a reasonable time and scope and what companies are willing to pay and put up with for an audit, right? Yeah. So, as both of us have seen kind of both sides of that aisle, when you're the auditor, it's like, it is really painful to try to explain the importance of meeting disclosures, assessing materiality, doing a true risk assessment, making sure your flow charts and your narratives, everything are up to shape. And yet, then when you get to the other side of the aisle and you're working as the controller or any kind of director of finance, whatever it is, you're sitting there, you're like, man, if I get one more damn question about controls, like everything, like if there was an issue, you'd already know about it because I would have no money, like the fraud would have occurred. Like, so it's kind of funny when you're sitting there, you're like, you're like, well, nothing's occurred because I would know immediately because the money would be gone essentially. And yet you're sitting there trying to spend so much time when you're already so busy within the organization, trying to accomplish other things, trying to satisfy the audit. And then you look at the bill and the billables, and it's just, there's really a balance here that the SEC is playing with that I worry that one day there's going to be a reckoning. I don't know when it's going to happen. I don't think it's these disclosures, but it's kind of an interesting addition to the assurance requirement.
Yeah, I mean, obviously it's in one way it's like good for accounting, right? For audit firms, right? They have additional scope that they can now bill for, which is great. I think the reason I think this is important just in general, especially with cybersecurity nowadays, is like, I feel like everybody kind of universally knows if you return something to Amazon, they don't actually put it back in inventory. They just either donate it or they just write it off, or it's sent to the return packages area. And it could be like a several $100 item, and it's just kind of written off. Credit card company that, there's fraud. They're just like, they just accept the fact that money will be stolen, credit card will be abused, and they give you your money back, and that's it. But I think it is important for investors to really have an understanding of knowing what is the risk tolerance that a company has for allocating. I mean, you're talking about massive numbers. for Amazon, for example, could be like, we've got $1 billion allocated for just like stuff getting stolen or returned or not working, that we're just going to write it off as like, that makes you start to, I don't know if it's because I've been watching Succession a lot lately, and I'm like, the numbers at which they're dealing with are just so extraordinary that like I can't even fathom it as a regular person, how you could just casually toy around with $1 billion here and there. But, it is like the amount of money that these companies must be making in order to have that sort of pool of money that's just accepted. Like, we're not going to fight for it. We're not going to try and go after. We're not going to try to repair these objects. It's not worth it. We're just going to say, yep, we're going to probably lose about $5 billion to this sort of stuff. So anyway, when it comes to cybersecurity, it's a matter of like, how much are you? It's not a matter of like if it's going to happen. It's a matter of when it's going to happen. Somebody's going to target your organization, and what's your how large of a scale are they? How materially impactful are they? And as an investor, I kind of want to know if you're being targeted all the time. It's like it's only a matter of time till there's like one major fallout, and then that tanks the stock, because it's just like this place is super at risk of privacy, security, information, all that sort of stuff. One of the things from the article says, in general, the rule will mandate that entities that experience a cybersecurity incident to determine its materiality, and if deemed so, then fill out a new item 1.05 on the Form 8K within 4 days. The entity will need to describe the material aspects of the nature, of scope, and timing of the incident, as well as the material impact or reasonably likely material impact of the incident on the registrant, including its financial condition and results of the operation. So, kind of what I was just saying about.
It's kind of insane though, because I mean it's quite a large ask to come back and say within 4 days of an incident occurring what the materiality of it is. What's this going to cost you? Because oftentimes with these things, and I've experienced fraud in the past in my roles, it's hard to pinpoint the scope until you really get into it. There's a lot of negotiation with, let's say you have wire fraud, right, between you and just one vendor that occurred. It can be really hard to tell what was paid and unpaid, because people are greedy, and by nature they're going to ask for more. So the vendor could be coming back at you and saying, well, they didn't pay $8 million, and you're like, looks like they didn't pay $2 million. So there's just a lot of complication with that. And when you look at data breaches and what that's going to cost you, it's like, well, what information did they take? Well, it's hard to uncover that. Okay, what's that information breach going to cost us with customers? What's it going to cost us in future economic performance? Because so materiality, I mean, that's a really broad statement to apply in this. I'm partway excited to see how an audit partner is going to explain this to CFOs, you know, and come back and say, well, I think it's this. And they, a lot of them really don't have the background to be specialists on this. But it's a big ask, and it'll be interesting to see, once this gets into practice, is there any kind of change in the way they do it, or are companies going to figure out a true procedure or policy that can help them do this within 4 days and, assess that scope of materiality.
Yeah. And I think there's then the opportunity for those to specialize in cybersecurity. I mean, that's a growing field and a growing area, and it has been in general. And kind of it's a good segue into, talking about the expanded scope when it comes to what auditors do. And this is kind of flown by under the radar. I didn't even hear about this until our legal counsel here had brought up, have you guys heard about the PCAOB making this proposal to expand the role of auditors to essentially ensure that all contracts are compliant and with laws and regulations, and the companies following these things that really, I think, fall under the scope of law, which is going to be interesting, because if the scope of an audit is now expanded, what do you do as an audit procedure? Pull 10 contracts and make sure that they followed the regulations and laws of that.
Yeah.
I mean, this is a really fascinating thing. And now you have our law firms interested in taking on this type of work. Would it be a separate and distinct thing? I mean, the way that this is being positioned is no, this is going to be part of your audit. And now if you're an audit firm, you see it maybe as a new revenue stream. Again, you can expand the scope of work, and maybe you start to hire lawyers. And I mean, it's the golden ticket if you're a JD and a CPA.
Yeah, I think it's, again, this goes back to that tenuous balance of what risk can you assure against, and how much work, is that going to cause, and what are you able to bill? And I think a lot of companies, as much as the audit firms probably hate seeing this, because it is, increases a lot of the work, and it increases a lot of the risk they take on as a firm. It doesn't necessarily result in increased billing, because companies really don't have a tolerance to increase it too much more. If you come back to me every year and you're like, I need to increase the audit this much more and this much more, it's like, well, listen, guys, like I have other things I need to invest in. But it's going to be attribute testing, right? And it's going to be interesting whether you kind of do a dual purpose within your revenue testing that you leverage for your, kind of planning and controls testing around the organization as well. But I just think what I don't love about this is the regulation side of the business is really expansive. And why auditors are very smart, very capable, knowing each and every regulation that a company might fall under is quite daunting. And it's really hard for a staff or even a senior to be able to identify those and be knowledgeable on those and to be able to properly perform this testing. It's putting just a huge burden on the auditor. And I really don't think that's ultimately fair to the auditor, and I don't think it's fair to the organization. At the same time, I do think governance is an incredibly important aspect that companies have maybe been lacking on when it comes to contracts and compliance with laws and regulations. And so I do think this is a little bit more of a burden that we need to take on as, the entity being audited, the actual company. And so it'll be interesting to see how it really plays out long term. Is this going to be a big lift on the auditor's perspective, or is this going to be a larger lift on the organization's perspective?
Yeah, I mean, when it comes to governance, it's insane how, as a company grows, as they scale, if you want to take a company public, I mean, this is the thing that I think so many people want to be entrepreneurs. They want to start a business. They want to build a company. And this is an area that I think is just so often forgot about. Unless you have that background that comes from really the accounting and auditing perspective, which we're very aware of the extent of what an audit entails, how expensive it is for accounting services like that. Mm-hmm. And when you expand it to this sort of thing, there's a big chunk of money that has to go towards just all these compliance measures and then paying somebody to evaluate and do this sort of stuff. And I just think it is, like you said, it's daunting because this is a whole other realm of work, which I didn't study law. No. You could correlate it to how revenue testing changed when revenue recognition principles changed, right? Which is still an accounting thing. It is a little more regulatory in style and in nature. So it's definitely within the skill set of abilities. But like you said, there's just such, and then if you really want to break it down, there's just such already it's a massive area. The next level is, well, each state has its own requirements as well too, right? And so
county can, city can, it gets, this is like, it's like sales tax, right? Like sales tax is incredibly complex because, city, county, state can all have different tax jurisdictions and and it's insane. And when you think about it, it's like, when you try to explain materiality to someone, when you're in accounting, you try to explain it to finance or, maybe your sales organization or something else. It's a very kind of difficult concept for people to truly understand of materiality, how you create it, how you apply it, its importance in the place. And when you think about these contracts, it's the same thing. As an auditor, when we look at the compliance, I will dot every I and cross every T when I'm reviewing that contract because I don't understand what is material from a legal perspective and what is not. I don't know what's going to hold up in court. I have no basis in understanding that. So I might chew up a contract, and I've done this a lot of times where legal will send a contract and you look at it from an auditor perspective, you're like, this is trash. Like, this isn't covering anything. I see all these contradictions. What's going on here? And they're not worried about it in the slightest because I think, there is a materiality and there's a threshold for a lot of the work they do and what's built into these contracts. And we just have no idea. And so it'll be interesting again to see, like you said, we're not trained in this. How is this really going to shake out in the marketplace? I understand why investors want to see this from the PCAOB, but I really think that auditors and organizations are going to hate this proposal.
Absolutely. And so just to summarize for anybody who is not familiar with what this proposal had said, it said if adopted, the proposal would strengthen auditor requirements to identify, evaluate, and communicate possible or actual non-compliance with laws and regulations. And the deadline for public comment on the proposal was August 7th, so this week. And so we'll see if this moves forward in some sort of watered down version. But a lot of just crazy things happening in the world. And with that being said, let's get on to the Have We Read It section. This is my always personal favorite little break in the action here. So we've got our news up to date, and we're seeing what's going on in the world of Reddit. And it's they're kind of on a summer lull a little bit. Reddit's cooled off after they had their drama with the APIs and the selling of the third parties, and there's a whole bunch of stuff going on with that. But I just thought this was a really cool, little interesting ad that showed up. So this is a actual sponsored post on Reddit from the Los Angeles Times, and I'll read it for everybody who's not seeing the visual here, who's just listening on their podcast. It's basically the caption of it says, "No AI here. A human copywriter wrote this ad. In a few weeks, we'll have a meeting to see if this approach was effective. It's humans versus machines, a battle for the ages. So basically, if you don't tap the link and subscribe to the LA Times for $1 for 6 months, less than $4 a week, the robots will win." And it's a picture of a broken keyboard saying, "Save humanity." I just thought this was clever, because this is just a prime example of this is the future that we're going to be actually having a crux with. I thought it was a really clever sponsored post. It's basically putting you in this moral position of, are you going to support the robots or are you going to support humans?
I mean, I've already succumbed to the AI overlord. I try not to say anything bad about them. I'm going to be really measured in what I say today, just in case they hear about it 10 years from now and hold it against me.
Yeah.
No, I thought this was a clever one too, and I actually saw this one pop up. The way I look at the GII stuff in particular, I think because I think AI is a very broad, subject. There's a lot of different AI out there, and I think a lot of what we're seeing today is primarily generative AI, a lot of the large language model stuff. And as great as it is, I think a lot of what it does is it provides you a cool co-pilot, right? It helps you out when you're I'm kind of struggling on the creative side. Have something just kind of shake out a few different responses for me, and then me as the creative individual can go and take quite a few stabs at it. And this is all based off what other people have submitted online. It's not necessarily the true thinking or autonomous, or I guess AI thinking or anything like that. But it's taken a lot of that stuff and said, hey, probability based, this seems like what you're looking for. So it's taking what other people have already created and saying, this is what you seem to like to get. And so, I think there's a lot of people that are really concerned about AI in the future, but I think it has a lot of potential for accountants. I think it has a lot of potential for marketing. I think it has a lot of potential for creatives and copywriters and everything else, because it takes you out of having to, this would be a good way to explain it. I am on the marketing team at FloQast, right? My background is all accounting, and now I work on the marketing team. Clearly, it's not great to have an accountant formulate a sentence that goes out to the general public. I write very much in technical accounting memo tones and that third weird person that we do in those memos. And you would never want to put that in front of somebody. And so when I send something to John Siegel on our team or anybody else, they probably look at it and they're like, this is the worst writing I've ever seen. But with tools like AI, I can maybe throw something in there and be like, oh yeah, that sounds a lot more human coming from a robot than it does from me. And it actually will make it to where our marketing team can maybe assess that and spend their time not trying to just convert what I say into normal human language, but into I'm going to just change one or two things and make this a really powerful statement to market, instead of saying, I have to rewrite your crap from the beginning, Stefan. So I think that a lot of these people are kind of freaking out with some of these things, but I do love the ad. I think it's a super clever ad, and it just shows that I think a lot of people are a little under the current, stressful about what it means for the future.
Yeah, I got my master's concentrated in marketing, and I think part of the area that people struggle with, and I personally struggle with this, is this battle of you have to put your ego aside. You want to be well, I made it. I want to be I made this thing, not AI. But you could spin your wheels for an hour trying to figure out an outline for a script you want to write, or to come up with a concept that you can just Google the answer. It's basically choosing not to use the calculator, even though the calculator is available, because you're well, I want to figure it out in my own head. And as noble as it is, and as great of a skill as it is, you're wasting an hour of time trying to do that on your own when you can get the answer right there. So it is one of those things where you kind of have to put your ego aside, put your pride aside, and be like, this is the future. How can I use this to maximize my time, maximize my effectiveness, my output? Though I do think what is interesting, especially from like a marketing standpoint, is like the future will be, it's this made by humans is going to be like the new Made in America.
Yep.
And the reason I think this ad is just particularly interesting is because it calls it out for what it is. Like, it's not trying to, and we live in a world, and I could go down a whole rabbit hole when it comes to like marketing and content marketing, how it's evolved from like, it was in your face with like, here's a billboard. Then it was like, actually, I'm going to have like somebody famous endorse it. Then it was like, okay, how can we like incorporate it with product placement? Then it was like, you didn't even know that you're watching an ad. You didn't even realize, like, it was just so baked in and subliminal. And it's almost coming back out of it now where it's like the only way, like, people are so sensitive to what's an ad and what's not an ad now that like, this is actually a better approach where you literally come straight up and say, hey, this is an ad. And it's almost respected for being honest and being truthful about it. So I just thought that was an interesting thing to sort of.
I do love that. I do love that statement. Made by humans is the new Made in America, right? Where it's like, oh, well, just, you know, did someone really spend their time on this, or did someone spend 2 seconds?
Right.
And you know, this isn't a clever thought that someone came up with. But
it's a handmade piece of art versus like a factory produced. You know.
Yeah. But at the same time, I look at it and I'm just like, well, how much of our content's all that original at the end of the day, you know? And this is, at the end of the day, GIA is generally taking already human-created statements and kind of combining them to say, oh, well, this is what, you know, after I bubbled all this together, this is what it distilled down to. So it is really interesting to see where it's going to go in the marketplace. Luckily, I feel like with accounting and the ever-shifting change of business, like, if anything, we just need GAI to like assist us in some of the more monotonous, mundane things that we do. Yeah. But I see why people are concerned about it. You know, it can be kind of scary some days with the responses it comes out with.
Yeah, I think it comes down to at what point do you fully entrust? You trust your auditor to look at the invoice and vouch the invoice to the check, making sure that the numbers are matching, the amounts match. At what, like, how much do you entrust? It's like, how much do you entrust your car to stay in the lane when you click autopilot? How much do you trust the AI to look at these two documents and be like, yes, it did get it right where those numbers are correct? And I guess, is there a certain threshold where you have reached like, okay, if 99% of the time it's getting it right, there's always going to be human error. Like, a human is just as likely to make the mistake and get into a car accident as the car. But it's like, how much do you grapple with, well, it could have maybe been prevented as opposed to a technical glitch, or the AI thought that it was a 6 and it was actually a 5.
Right. And I think that's where the other interesting thing is like, you bring up 2 points I think are going to be interesting in AI in the future. What are auditors going to have to do around it? Right. And so if you have generative AI or any kind of AI within your finance ecospace, your FinTech stack, what's the auditor's assurance around that going to have to be, right? Are they going to have to get in the black box of the machine and really prove out how it works? Is there going to be a huge blow up in the SOC 2 space, right? Like the amount of work that IT, like, you know, your IT auditors have to go in and do to figure out if systems are performing correctly. And if there's a breach or there's any issues, how expansive is it going to be in organizations? So I do think from the regulatory risk area, it's going to be massive in the future. And when we talk about, hey, it's already like tenuously balanced on how much organizations are willing to pay and how much auditors are willing to do. But then I think the other kind of interesting thing about all of this will be, this isn't really anything like new. This is just like the calculator in the future. But I do sometimes worry with, if the AI does all the easy stuff, how do you learn how to do the hard stuff, right?
Yeah.
And in theory, we've done that, right? Like, you do math without a calculator for so many years before they let you in school start using a calculator so you understand the fundamentals. But when you think about how much you learn on the job as like a first-year staff in audit or even a staff accountant at a company, it's like, well, if you're already starting using GAI, how strong are your foundations in the future, right?
Yeah. I mean, I'm imagining a world now going down this rabbit hole of like the AI auditing the AI controls, and, or
well, as long as I don't have to do it,
or asking AI what the proper solution to how to handle AI is. Anyway, that's a whole thing that we'll pay, but it'll be interesting definitely to see how that kind of goes in the future. So before we start going too concerning with the AI stuff, we can get into the section of that's concerning. And this is, I think, one of my favorite sections of this episode that we're going to have today, because this is interesting. Now, I don't know, are you a soccer fan at all? You follow football a little bit?
Yeah, not a huge soccer guy. I do know and follow ever so slightly, and I am a little bit aware of what you're about to bring up. But I do think the whole like economics around these clubs and the business model around these international soccer clubs is mind blowing to me.
Yeah, I played soccer growing up. I enjoy watching the World Cup. I'll watch some Premier League here and there. Whenever the World Cup is on or the Olympics, of course, I'm tuned into it. I'm not all up in the business of watching every game. My brother's like a huge Manchester United fan, so he's very familiar with who's getting traded where and the different players and whatnot. But like you said, from a financial standpoint, this is pretty fascinating. And for those that aren't aware, this is how cool it is to actually, like, this is the cool part of accounting, where you actually understand like some of these things that are going on. And the story is only relevant if you actually have that financial background. This is from Goal, and basically the entire Juventus financial scandal is explained, why the Beyond Canary have been kicked out of Europe. So I'll just give a lowdown from the article for those people who are not familiar with what this is all about, because it might sound like mumbo jumbo, like, what are you talking about soccer? What does this have to do with accounting? Well, the club was hit with an initial 15-point deduction by the Italian Football Federation in January for financial irregularities and false accounting in relation to past transfer dealings. It was announced that the club had accepted a 20 million euro fine and 1-year ban from competing in the UEFA competitions for breaching the organization's financial fair play regulations. Now, just to pause there, I didn't even realize there were financial fair play regulations. And I don't think people realize this, that at the end of the day, sports teams are a business. Like, you think, oh, well, they make so much money on the concessions and the tickets. And I was like, yeah, but there's also like a whole business operation that's going on behind this. It's not just, we buy players, we sell T-shirts, we sell jerseys, and we sell food, and that's it. And apparently many teams, including Juventus, are actually on the stock market, which I thought was fascinating. The issue is apparently a concept called plusvalenza, which is how they define capital gains being made on transfers. So this is where the accounts get to be super nerdy. Right. You're talking about this concept of capital gains. And so here's the example to bring it all together. Juventus signed a player for $100 million on a 5-year contract. They would amortize the cost of the player. Interestingly, you're amortizing the cost of a human being. The cost of the player's registration rights over the duration of their contract, most likely spreading the payments out equally over 5 years. In short, the player's amortized value would be $20 million per year. So if Juve then sold that player after 3 years for $60 million, they would make a capital gain of $20 million on his registration rights, the $60 million minus the remaining $40 million of amortized value. And so they're using this tactic of valuing a player. They're picking an amount to value a player at, and then whatever they decide to trade them for, they're saying, well, they were only worth that, and we sold them to another company for this, or another soccer team for this. So we're writing down this gain, and it's totally made up monopoly money because you're talking about valuation. But it's just, I've never seen the valuation of human beings being used as a capital gains accounting mechanism.
Well, that's the interesting thing. I was like, I can't think of anywhere in the codification that I would look to even address this problem, right? If someone's like, hey, we're looking at the capital gain related to a transfer deal. And, I had friends that audited sports teams at KPMG, and I should have asked them about this, but it never occurred to me. And I'm sure there's a way we do it even in the US, but it's just kind of like, honestly, if someone said tomorrow, I'll be like, hey man, can you write an accounting memo on this? I'm like, I don't know where to look. I don't know how to do this. And I don't say that very often, but I think I do think it's super interesting that one, it's a public company. So all of this financial information is very much readily available to the public. It needs to be, to a standard of, public reporting. When a lot of times in the U.S., we're used to these being held as, privately held entities that people just really don't have a lot of visibility into. It's all behind the scenes. Owners like to keep it that way because they want to be able to make money and not have people really getting in their face. But when you get into these big European soccer teams and these international soccer teams, not all these teams really make all that money, much money, right? Based off how much they're spending on their players and everything else. It is more about, I think you even pointed this out in some notes you sent me. It's more about prestige, right? And so it's all of a sudden, it's like, well, you just got into like a very murky territory on even how this company is meant to operate itself and what's the financial goal of a company. If a financial goal of a company isn't necessarily to make money, it changes the name of the game quite significantly. But when I look at it and they talk about, hey, how do you recognize a player? Well, you paid cash, you signed a contract at the beginning, you're saying their value was, $20 million over 4 years. And so it's $5 million a year. If you're able to trade them 2 years in because they grew in value for $40 million, then you just recognize a capital gain. And I guess from a investor perspective, if you're looking at an organization that's really able to just pick talent and leverage them for a capital gain, then that could be a suitable investment policy for them to run with. But it is a really weird way to look at it.
Yeah. I mean, I just don't see how. I mean, I think one of the issues here is like, what's the incentive to actually have that capital gain? It only exists, like you said, for these publicly viewed financial statements where it's like this company, I keep calling it a company. Right? It is a company, but it's like this soccer club is losing money perpetually. How do we make it look like we're not losing money? We're actually successful. But to your point, like you said, what does this have to do? What's the difference between the U.S. and Europe? Well, why do billionaires buy soccer teams? It's what I'm sure everybody wants to know. And so I thought this was interesting because this was a study from Deloitte. Why do billionaires buy soccer teams? And it's not for profit. And especially when it comes to Europe, it's literally just a pride thing. And so for them, most of the time, it doesn't really matter. They're just trying to assemble the best possible team that they can. And I think one of the big issue that a lot of these teams have had in Europe is that they're overvaluing players. I mean, you for those not familiar, I mean, the amounts of these contracts for soccer in Europe is insane. It dwarfs the size of contracts of like regular sports leagues that we see here in America, which we already think are pretty insane. But it's average players in Europe are getting contracts that are the size of like LeBron James. When it comes to here in America.
Yeah. And, these are incredible athletes, no doubt. But like, LeBron James is one of the GOATs, right? And or even if you look at different football players, like they are dwarfing contracts across almost every kind of professional sport in the U.S. And it's pretty crazy to see that they'll do that just to build a team that they like.
Yeah.
But the connections they get from it are pretty exceptional. But, when you also look at the way FIFA's run soccer internationally as well, to go back to a previous point of yours on like, hey, like, what was it? The fair player trade valuation, financial fair play regulation, I believe is what it was.
Yeah. Yeah.
I also think it's a bit of an oxymoron to have that regulation associated with like FIFA, right? Where it's like just blatant corruption across the board. You're just kind of like, oh, you have laws around this. I didn't think you guys ever cared. So I wonder if there's also some other reasons billionaires hold these teams that are, it's like, well, the public companies have these fair play regulations. We, on the other hand, have these deals that most of the public doesn't see or really understand. Yeah. But again, I don't dive into soccer a lot, so I don't always see a lot of this. But it is just insane that the pride to own these teams and to be involved in these different leagues is that strong for people.
It's a bit of playing The Sims. Billionaires are playing The Sims with real people, and they're fine blowing $1 billion to put together an amazing soccer team because of the status. Like, this is their legacy that they're hoping for. In America, it's can I build the biggest company? For there, it's can I be the best soccer team? And it is really fascinating how just ingrained into the culture it is for them. And the reason why I think the United States doesn't have as robust of a soccer league is because in America, teams are typically run for profit. I mean, there's a reason why the New York Knicks just can't win, but it doesn't make a difference because they make a whole bunch of money, right? And it's in Europe, it's not about making that money. It's about literally just putting together the best soccer team. There's so much pride that comes around your club. So I think that's why the U.S. typically kind of lacks when it comes to the soccer on that front. But it is sort of eventually kind of catching up. But players go to Europe to play, and that's enough on soccer. But it is really interesting. I just think overall that this whole entire case and situation is based at its very core as an accounting principle thing. This is a playing capital gains with human beings. It's not capital gains on a building. It's capital or on an investment. It's on a actual person. And it'd be kind of fascinating to think of companies actually treated. How much is a brand Evangelist worth?
Yeah, like exactly.
And if you could,
am I being traded? Yeah,
it would be kind of funny to see companies trading employees.
Well, you kind of see it with stock prices fluctuating based off who becomes a CEO, who becomes a CFO, everything else. You bring in, a successful CEO from another company, investors can drive up the stock price overnight, right?
True.
And so the trading isn't happening on, the financial statements, but you do see it in the valuation of a company based off the composition of people that are there. When you go to buy a company, if the founder is still involved in certain ways, that can affect the valuation from, how investors see it. Okay, well, hey, this was a great idea. You guys ran with it. Oh, you got rid of the founder 2 years ago that drove a lot of this before you tried to sell them to us. Are we still as interested? Maybe, maybe not, because they could have been a lot of the juice behind that economic engine. But if you, it does affect valuation. It's just not as on the nose in the financial statements as it is with the soccer teams.
That's a really, really good point. Yeah. And I just to touch on that with a little footnote is like my mom worked at AIG and she was in the finance, she was in the finance department all throughout the 90s. And I remember her mentioning before AIG had the collapse back in the 2008 crash that whoever I forget who the CEO was at the time. And she's like, I knew when he left, like that was not going to be a good thing. And she's like, I should have pulled out then. Ended up not doing it. So everything tanked, 7-to-1 reverse stock split. That was my whole college fund that just kind of disappeared in a year. But it was funny how it is very much so tied to the individual. Like, this is the person who we trust and you put your faith behind. And at the end of the day, every startup is an investment in a person. You're not, sure, you have a good idea for a business model and you might have a good product or something, but at the end of the day, it's the person to execute it. Anybody can come up with a clothing brand. Anybody can come up with a new app, but do you trust the person who you're giving the money to execute on that and you believe in that person?
Yep. And I think there's a lot of brands like that out there where you see where these serial entrepreneurs can drive valuation for the organization because of how successful they've been.
Yeah, 100%. So as a last little piece here, this is from Accounting Today, and this is just related for all our tax accountants out there. I mean, everybody really, this is applicable to. The new 1099K threshold is set to sow confusion. And this has been kind of ongoing discussion. I think I've mentioned this previously in the past. And for those unaware, the provision of the American Rescue Plan Act of 2021 states that it requires third-party payment vendors to report information to the IRS for gross transactions of at least $600. And there's been memes all about this, about like, the government losing billions of dollars of inventory at the Pentagon. Yeah, blind eye. The government, letting companies get away with these big monopoly transactions, blind eye. And then like you paying your friend on Venmo, scrutiny.
Yep.
And this is the exact, version of it. It used to be 200 transactions and $20,000 in gross sales. The issue that's important here is less so of, okay, what should the dollar amount be for when you have to like report something, and more so just the confusion around there's too much administrative burden for any of these entities to see every little transaction. What's a reimbursement for a movie ticket, or what's you reselling your old TV? You don't have to pay sales tax on that sort of thing.
Yep.
Getting just mixed in here with actual things that you would in theory have to report. And so people are going to either end up completely missing it, or they're going to be over reporting. And then as a tax accountant with your clients, you're going to end up in this mishmash of like trying to figure out what actually you have to report, what you don't have to report. I just think the administrative burden of this is just totally insane.
I agree. I think this is really picking on the wrong thing to solve when it comes to the IRS. And I think it's not because the IRS setting this threshold. I think it's different congressional acts that are causing the issue, right? I think the IRS would be like, we don't want to spend our time on this. And then Congress comes and said, you do now. And they're like, all right. And I feel for them. I really do. But as you said, I mean, like, how is this going to affect companies like eBay? How is this going to affect, I think Venmo is a great example, but any of these reseller platforms, Poshmark, anything like that, are they going to have to look at these things? And as third party, like, they're not necessarily third party vendors buying the product, but they are invested. They are a third party vendor that's kind of invested in the transaction. Are they going to be subject to reporting on this stuff? Are they going to be sending people reports? Are they sending information to the IRS? And is that going to cause issues where the IRS is coming back and saying, hey, we think you filed your taxes incorrectly. We're coming to do an audit on you simply because there's a miscommunication from a company that doesn't know their place in this. And, I've personally had that where my college, despite having very good people in their accounting function, was literally like issuing certain student loan like information to the IRS incorrectly. And so like most of the college was getting audited by the IRS because like, well, you claim this on your tax returns, but your college said that never happened. And you're like, you go there and they're like, this is what the IRS told us to do. And it became a whole kerfuffle for a lot of people. Like I had multiple friends from college. Like it was just like everybody overnight was like, I'm being audited for the IRS. Then it was easy to solve. You send them like one letter and they're like, oh, okay, we get it now. We see what's going on here. Yeah. But I think it's going to be the same thing where it's just going to take one massive entity to kind of mess up this. And all of a sudden, a lot of people are going to be audited. There's going to be audit backlogs. And it's not going to be on the big misses when it comes to collecting internal revenue, right? There's other areas that are like more concerning with people having fraud with it comes to, I think it was in the news, but just like the relief from COVID and, those type of things. It's like, maybe we should focus on other things first. And it's going to be a pain in the butt, guaranteed.
Yeah. I mean, that individual who's just selling embroidered patches on Etsy doesn't really want to have an accounting system in place to track stuff. So where does the burden lie? Is it, like you said, is it on these just platforms that are just intermediaries? Like we're just helping you sell stuff to other people and we just take a fee for offering you this platform to do it. Is it now on them, like you said? And accounting departments at all these sorts of companies need to know, is the burden on us? Is it on them? Are they going to send us something? If they don't send us something, how do we know what to report? Do I have to be tracking every single thing I sell in an Excel? And then I have to know what state I sold it in, because if I hit economic nexus in a certain state now, and I have to remit sales taxes, and how's that going to work? Just a total debauchery, which again, you get away with most of that after like you hit $20,000 or more. Okay, maybe it kind of makes sense to have somebody who's an expert come in, but at $600 just kind of seems foolish. So whether legislation can actually fix this, clarify things, I would be scared come January 1st if this has not been at least kick the can down the road another year until they figure it out. I think that might be what's able to happen. Maybe they do another, we'll push it again. I don't know if they can get legislation in action to kind of fix this ahead of time, but we'll see.
Yep.
So anyway, wrapping things up with my favorite section, how should we account for memes? Who doesn't love a good meme? And we got two here. This is one from the Big Four. And it's the client. You ask the same questions every year. And me. It's an annual audit.
What I love about this is I feel it very really from both perspectives, where you're like, I just want you to answer this little question so I can move on with my day as an auditor. And then I understand it from a controller. You're like, can you just stop bothering me while I get my real job done? Because, I used to think the audit was the most important thing as an auditor. When I became a controller, I realized that it is, most of the time it has very little impact to me or the organization. I think a little bit of that depends on your organization staging, whether you're, privately held, pre-IPO, public, that kind of stuff. Also your partner and a whole lot of other things. But I think for a lot of businesses, the audit really isn't considered as all that important, and yet you're kind of you spend a lot of time on it. So I feel it from both sides. The other thing that I really liked about this is I kind of thought about it from two areas. So there's those questions that you get that are just like, hey, I got to do these closing questions with you. Has anybody asked you to falsify anything on the financials? Is it X, Y, and Z? And you got to go through that questionnaire. But there's also the question of like when you're the auditor and you're like, hey, have you guys fixed this glaring control error that we identified last year and gave you significant weakness on? And they're like, why you keep asking me? And you're like, because it's kind of important, man. They're just like, nah. Like, you get nothing out of them. You're like, this is a material weakness. This is a significant deficiency, and you don't care. And they're like, yeah, no, I really don't. And it's a little bit it kind of also reminded me of those points in audit where you're just like, yeah, okay.
Did you feel a shift in your mindset when you moved from public into private? Because I know obviously the one thing right off the bat is when you're an auditor, that is your job. That is your life. That is 100% of your time is an audit. So it is your entire world. It is everything. When you're a controller, the audit is 10%, right? So you're talking about something being valued totally differently by two different people. So I get that. But actually, like, you knew what it was like when you were an auditor and how you viewed it. Did your mind actually change where you kind of felt entitled to be a little snickery and a little bit like, I'm kind of going to give these guys a little bit of a hard time just because I can. And I feel like there is like a sort of like mindset shift where even though you're aware of the fact that it is an annual audit and you do have to answer the questions, you kind of just like, oh, these guys are so annoying. And it's like, you literally were that 2 months ago. What are you talking about?
I would say that the first audit I did after leaving public accounting, I was very much about the audit. I was like, let's do this right. Let's do this well. Let's take this all the way. I was even beating them up on like, I didn't think they were doing the right procedures where I was like, you're not even assessing the risk correctly. You should be doing this, not this. And they're like, why do you care? And it's like, because I used to do that and I want it done correctly because I can, my dream was like, hey, I'll enter a controllership and one of these days I'm going to do an audit correctly, right? Like that was like my first audit that was like, this thing needs to be done correctly for once. I'm tired of it not being done well when an audit should always run well. And I really went into that mindset. I think the audit did go very well. But then as I matured within the organization, I understood what was really important for the organization. I started to see that, the audit wasn't really driving any kind of significant value for my company. And so going through all this pain, spending all this time on that when I can spend it in other parts of the organization, driving true economic change for it, I can help, increase the speed of reporting to different business leaders. I can help explain what's going on within budgets and actuals to different decision makers. I found that to be much more important. And so then when the audit came around, I was like, I don't have time for this. I'm trying to explain to this new director over here why they need to do X instead of Z because I'm seeing these numbers kind of go down every month and that's this KPI slipping, right?
Yeah.
And I need to help educate them on that. That's my job and responsibility in the organization. This audit really isn't worth all that much. And so I think as I kind of matured in that role, I started to have, I wouldn't say less respect, but just a better understanding of the place of audit for the organization. But I would say that I came out in that first one hot and heavy and ready to just like run that thing to the ground, make it the most pretty audit file that ever existed, the best support provided, that all that kind of stuff. And then it quickly fell off about 6 months after that.
Yeah, makes sense.
Yeah. What about you? I feel like you've had to go through one or two.
Yeah, I think just it's funny how you quickly adapt to the new environment in which you're in. Being, I'm not one of you anymore. I'm not one of the auditors anymore. Like, I came out being like, it would be so easy to just like, I know what the auditors are going to ask for because I did it. So like, why don't we just make all of our work papers look like the audit work papers?
Exactly.
We could just feed them the thing. And then, like you said, you realize that the things that you actually need to focus on and do on your day job is not just, you can't spend 100% of your time just making the audit look perfect for the auditors, because it's just so very quickly those systems and ideas that you have of this like perfect dream world in place just are like, I just send them the stuff, whatever, whereas like I always dreamed of like having it so organized and making it so easy. It's going to be the most efficient audit ever. But you do quickly kind of like group in, and when you join a group of people who have been outside of public for a while, and you start to rip on the auditors and like just rip on public just as much as soon as you leave. The same 100%. Way that when you're in public, you're ripping on the clients. You're like, these clients all suck. They're a pain in the ass. They don't do anything right. Then you become in private. You're like, these auditors are so annoying. Like, they're just a bunch of dopes. They don't even know what they're doing. And it is kind of funny how you kind of pivot and switch on a dime.
Yeah.
So I do want to
100%.
So I do want to get to wrapping this up with our last meme here. This is from Netcap Girl. Great Twitter name here, Sophie. Pulling up to the earnings report when you own 2 shares of the company.
I mean, depending on what shares those are, that's a lot of money. Like there's a lot of companies. If you said, "Can you buy 2 shares of this today?" I'd be like, "Not comfortably." So it's I do kind of find this one fun.
This is, like I said, this goes back to what we were talking about earlier, is like, at what point does your mind shift in the way that you see money and like how valuable it is? Because, and I had this conversation with different people over the course of the last decade where I could talk to my cousin and she'd be like, I have $1,000 in my bank account. Like, we're going to have a good night. This is going to be a great weekend. And I was like, that is like, how do you define a lot of money? And it's like, well, okay, well, some people are like, oh, if I have $100,000, I have a lot of money. Some people are like, oh, I have $1 million, I have a lot of money. Some people are like, oh my gosh, $1 million, I can't do anything with that. And I thought in Succession, it was pretty funny. There's a scene where they're like, oh, well, $5 million, it sucks because it's not enough to retire, but it's also, you have no incentive to work anymore. And it's just like how people view money. And it changes, like you said, the same way that you talk about from when you join auditing, you start to talk about, oh, it's $2 million, it's below materiality. Mm-hmm. Right. And then I'd be curious for you as like when you're the controller of a company at a large amount and you are talking about moving a money in such a casual way, and it is significant amounts of money, you're acting on behalf of an entity. You're not treating the way that you view that money the same way as you would if it was your own dollars. And like when that mindset shift actually happens, and like that's got to happen to somebody who starts working at a PE company, right? And they might be working for a PE firm and being like, okay, well, we're going to invest, I think, probably like $13 to $15 million in that thing. And you're like, whoa, like, should we put it all in that company? And you have to like reframe your mind on how you approach, spending. Because I can't fathom how me putting $13 million into something is going to generate $30 million for me.
Or kind of like that Succession point. Why don't I just go out and enjoy my $13 million until I die? Right. It's like, I'll have a lot of fun. What I find crazy about it is there'll be moments where you're reviewing something, you'll look at an invoice, you'll see some kind of error with it, and you'll say, okay, how pervasive is this? What's the scope of it? And you kind of assess the materiality of the impact, right? You're like, okay, what's going on here? You get to the root cause. And you might say, all right, I think maybe it's $20,000 worth of like error that has occurred amongst 100 invoices. Our ability to change that and get that money back, because maybe this $20,000 error is over $1.2 million worth of invoices, you don't chase it down, right? You say, well, I can have this person chase down $200,000 worth of errors that are much easier to collect on shortages or whatever else in a contract or in an invoice, and collect on that much easier. So I'm going to say, write off the $20,000, absorb it. It's fine. It is what it is. And let's see what we can collect on this $200,000 of this $1.2 million, invoice with these customers.
Yeah.
And I think but at the same time, this is the crazy part. Then someone will come up and say, hey, Becca in sales spent twice her per diem at conference last week. And I think we should hit her with a car. And you're like, do it. Yeah, use their car so no one gets back to you. And it's like, It was $70. It didn't matter. Like, right. And you like, and someone will just be like, I'm gonna find Becca in the break room and I'm gonna have words with her. And it's like, there's no reason. You just wrote off $20,000 literally 30 seconds before this conversation, but it came to per diem and all of a sudden you're pissed. So what I find interesting is it's not just, hey, here's my perspective on materiality for the entity. And because now I work for this massive enterprise organization, all of a sudden, write off $2 million. I don't give a shit. It's actually really situation based. And it's like, if someone's breaking the rules, all of a sudden I feel like accountants were like, there is no materiality threshold low enough for me to not go after them. But if it's like, hey, we could probably fix that, but it's going to be a big pain in the butt. It's like, I think we should push materiality as high as we can before we have to deal with it.
That's so true. Yeah, absolutely. The breaking the rules aspect of it is, if it's inconvenient and expensive, then we ignore it. But if it's something that we take personally because somebody did something that we feel like is morally wrong, ethically wrong, or just against the rules, or we didn't get to do it and they got to, and that's not right.
Yep.
You do take a critical eye on it. And I think at the end of the day, it's just everybody wants to feel important. And there's a way to feel important by being like, oh, I can write off $20,000 because, it's not really worth the burden, and you kind of feel like a boss. And then there's also a power play when it comes to feeling important about like, I'm going to reprimand them because I found something that they did that was incorrect and wrong. So,
yeah. And I think there's also a generational thing with it where, the past people would chase a dollar amount and they always want to make as much money as possible. And they would be willing to have pretty brutal work lives to make more money, right? And I can, personally, I can relate to that quite strongly. I think anybody that's worked in public accounting can relate to the idea of doing really hard, brutal work for a future promise, kind of an enticing offer because that's what we live through. But I think as you look at younger generations, and I think this is a good thing, they'll look at it and say, well, why would I put up with all that? I'd rather just make a little less and be happy somewhere else. And I think there's also, and I am legitimately curious to see how that'll affect our concept of materiality going forward, and if it's going to impact it at all, or is that just, well, it's a little bit of a generational difference on value of money and work-life balance, and it swings both ways over time, and it's really not going to have any kind of blip.
Yeah, absolutely. It'll be interesting to see how that shift in how people view and approach work will impact that sort of thing in the future. So that's a kind of interesting take. I don't think people have really thought about that too much, but it will be interesting because, like you said, it all comes down to the individual's perception of what's material to them and what's important to them. So anyway, this has been a great session. It's been awesome having you hop on here as our very first different co-host in the absence of our beloved Mike Whitmire. So thanks for coming on and chatting through all this stuff with us.
Awesome. Always welcome. Always open to do more work with you guys in the FloQast studios, but it's been a fun to be on the FinTech Flo today.
Thank you. All right, everybody. Have a good day.
Thanks for tuning into the FinTech Flo. I want to give you a heads up that if you are looking for CPE credits, this is eligible for 1 hour. If you'd like to learn more, check out the link in our description to get those credits.